Welcome to Incremental Edge. This is part 3 of our series recorded live as part of our Investment Savvy CFO discussions. We shift to an investor perspective with Tom Wildig from Palatine. We explore what happens once investment becomes a reality, from due diligence through to operating in a private equity environment. If you're preparing for investment or working within PE, this conversation will give you a clear view of what investors really expect. So we're going to talk a little bit about what PE investors expect from CFOs, and again, combination of questions that we hear often from CFOs and also ones that have come from our audience. So first question, so when you're assessing a business pre-deal, what are you really assessing in the CFO?
Yeah, I mean, I think obviously we don't get a load of time in a process pre-deal with the CFO one-on-one. So a lot of what we see and assess is what gets presented in the numbers and the diligence. So I think quality of the diligence, how easy it's been to collate that information, inconsistencies in data. I think that, said it before, but that probably we're testing the fundamentals there of the finance function, its ability to produce quick, reliable data, and the sort of softer side of it, comes from limited interactions, and probably in a group function as well. So it's a combination of openness, transparency, communication style in that sort of group engagement, but fundamentally assessing the numbers and the trends and the performance and the ability to report in a timely fashion. And I think, don't underestimate the number of advisors that get involved in a process to perform that diligence exercise, or your corporate finance advisors. And we will work with those people day in, day out, week in, week out. So, you can guarantee that we'll be asking them their thoughts and views on the CFO and the finance function as well as part of that process.
Yeah, that's interesting. So how the CFO is interacting with all those different people involved pre-deal.
Yeah, and how easy it's been to diligence. So, we'll get we'll ask, timeliness of response, how easy it's been to get hold of the data and the information that they think they should be reporting on. And obviously financial diligence is the main area of that, but it will spill into other areas as well, corporate finance advisors, etc.
Yeah, and so what does investment ready actually look like?
Yeah, I mean, it probably is having those fundamentals in place, embedded in and lined up. You're not going to get very far through a process if those things aren't there. So track record of data and information, increasingly proving out some of those key themes. So thinking about quality of earnings and why businesses are attractive and what drives valuation. One thing, companies saying we've got high recurring revenues and low attrition, and we're really good at cross-selling and upselling, and we can do X, Y, and Z. Well, where's the data? Can you prove that? And not expecting that to be perfect on the point at which we invest, but increasingly being able to prove out those points and demonstrate them. I think getting that lined up and ready pre-process is fundamental.
Yeah, and so when you're going through that due diligence process, is there any holes that you're really looking out for?
Yeah, I think the kind of the fundamentals of trading performance, again, I'll try not to use the phrase too many times, but no sort of surprises or volatility. Appreciate that might be more of a commercial and a finance point, but certainly, any issues, any things hidden in the balance sheet, any sort of WIP build up, working capital changes, cash pinch points, the obvious things will get scrutinized and focused on, and kind of wanting to understand why. Not necessarily because, well, A, has it been resolved, has it been rectified, but B, back to your point, kind of the assessment of the business and the finance function in it, and how well it is to equip with the business as it is today. But as you go into private equity and you think about probably introducing debt for the first time, leverage, covenants, everything that goes with it, is that platform robust and solid, and can it take all that's coming over the next 2, 3, 4 years?
Yeah, and so this pre-deal time, it's pretty heavy going for a CFO, isn't it? How do you suggest they transition into the first 90 days once the investment's in place, and what should they really focus on?
Yeah, we get quite a few management teams that go on holiday as soon as we get a deal done and have a rest and clear their heads. But after that, I think back to the point around debt and leverage, and particularly if it's the first time, I think getting all over that facilities agreement, what it means, what you need to report on, how you need to manage it, I think is fundamental to get up to speed on quickly. Cash as well, not from a negative perspective, but often Peter made the point before that private businesses will often kind of sit with a load of cash in the bank because they can, successful ones that generate a lot of cash, and they'll give themselves plenty of buffer and headroom. When you do a deal, as people will know, shareholders take that out as free cash, and you start with zero or close to zero and put the facilities around it in place. So it might be the first time that there's been that real requirement to kind of manage cash, look at short-term cash flow forecasting, etc. So I think and there's nothing worse than getting off to a bad start on some of those points. So it is a bit basics and fundamentals, but particularly if that's new to a business, it's definitely key to get on top of very quickly.
Yeah, makes sense. And how quickly then do you expect issues or underperformance to be surfaced by a CFO?
Yeah, early as possible, I think is the short answer. Obviously discussed it before. I think that openness, that transparency, that communication, I think the challenge often for a CFO will be you've got the rest of the management team and CEO in particular who, perhaps by the nature a little bit more on the front foot and salesy, and we'll work out a solution, and let's not jump up and down about it too soon before we've worked out the answers. And probably CFO under a bit of pressure from the CEO to sit on it for a week or so whilst you work out what the solution is. So there's a delicate balance there, right? We're not expecting day-to-day issues and challenges to sort of get surfaced, but I suppose strong CFOs who can sort of stand their corner in that regard and have that open, transparent communication. But yeah, early and openness is the key to that.
And we've talked about pace, we've talked about difficult situations, but how do you expect CFOs to handle difficult decisions?
I think collaboratively. I think someone made the point earlier. There's probably potentially if you're kind of new in role or with new investors, I suspect there's that feeling of my issue, I need to sort it out. And the reality is, one of the beauties of the private equity model is kind of everybody's incentivized in the same way, and no one wins unless everyone wins. And so we go into it with that mindset of that sort of collaborative approach, and we want CFOs and other members of the management teams to be thinking about it as business owners alongside us and thinking about where we might get to over the next 3-4 years. So I think whilst they may be difficult conversations and difficult decisions, we genuinely try and see it as a partnership and hope and expect that CFOs will come and sort of communicate openly as soon as possible. So I think dealing with it kind of on your own and trying to accept that people will want to process, understand, work out scenarios, etc. at a high level, but kind of expect it to be dealt with round the table rather than individually.
Yeah. And that leads me on to my next question, actually. So CFO is often part of the board team. What does a high performing board look like to you?
Good question. How often we crack that, I don't know, but I think clarity of roles and responsibilities. I think we come back to what we call strategic growth plan, value creation plan, called by others, but where there's that clarity of where you're trying to get to, where the board meetings are not spent talking about the historic performance and the numbers for the last sort of month or so, and actually I think that's probably a sign of a good CFO and a good finance function if the pack speaks for itself when you spend 10 minutes talking about the historics and the rest of it is strategic, forward looking. So I think it's a board that's got that ultimate objective exit in mind, and then they're focusing on the 3 or 4 things that are going to make a difference to get us there. I think too often you can get bogged down in, talk me through this bad debt exposure over here, or let's have a chat about what's crept up in overheads in the month. Obviously, all of that is to some extent important, and we'll want to understand it. But if you're doing that in a board meeting and around the board table, you're probably not being hugely effective.
Yeah, so lifting out of that and having that more strategic conversation about those priorities that are getting you to the exit value.
And I think the onus is on us a little bit as well, because, as I said before, most people from an investor perspective who end up sitting around the board table are accountants by background. So it's easy to sort of default to an intellectual debate with the CFO about the rights and wrongs of certain treatment of things. But the reality is you can deal with all that offline, and the board and an effective board should be that forward-looking mentality.
Yeah, and how long do you have with a board on a monthly basis as the investor?
I think one of the answers to your previous question to Peter is about what's often unsaid in the board meetings. I think one of them is, how much longer do we need to go on for with this? Because some of the best boards that I've been involved in are 2.5, 3 hours, and yes, there are times when they need to be longer. I don't know, you've got big M&A on, or something particularly a meaty topic that needs to be covered, but that there's I think sometimes a temptation to drag them out a little bit and making sure everyone feels like I sometimes wonder whether they kind of think the private equity house are expecting a full day out, and for it to go through the motions a bit and last all day. So for me, if you are talking about the 2, 3, 4 big topics that are going to make a difference, yes, there needs to be an element of financials, looking backwards, looking at some forward-looking metrics, etc. But if you're going beyond 3 hours, I think you're probably starting to lose the audience a little bit.
Yeah, and if a CFO is not in an invested environment today, but looking at how to prepare the business to get there, what would you suggest they focus on most? Yeah,
I think getting through a diligence process these days it's got harder and harder in terms of demands from an investor. The people want to see data every which way. If you're making the corporate finance advisors will kind of love writing about quality of earnings, and we can do this and we can do that, and the response will always be, well, show us the data. How can we see that? How can we prove that out? So I think making sure you've got I've said it a few times, but it does come back to the fundamentals. Assume you're selling the business tomorrow was the phrase that was used earlier. So absolutely make sure everything's in order and your ducks are in a row well ahead of a process. I think beyond that mindset of sort of growth and forward looking and forward thinking, and how do I support the rest of the board table and to deliver on those 2, 3, 4 key things. There might be one that I can drive, but there might be 2 or 3 others that I can touch as a CFO.
Yeah, and a question that's come from our audience. So what stage in private equity-backed businesses do you typically see finance functions split between traditional finance and commercial finance, and what drives this?
Yeah, I think the nature of the business drives it a little bit, the requirements of the business. So there's probably no one size fits all in terms of what we look at in terms of where it's got to. I think increasingly, if the average business that we invest in is probably 30-40 million turnover, 5 million of EBITDA, it's probably 50-50 where there's that clear delineation between the two. We see it more in sort of data-rich businesses, perhaps. More. We've been investment in a business called Fulfillment Crowd about 9-10 months ago. Very strong commercial finance team, but they've got their own proprietary tech. They've got loads of data in that business. They're selling into e-coms brands. It's quite fast paced. You can make quite a meaningful difference if you've got that data at your fingertips. Some other sort of more, I guess, business service, industrial type opportunities that we look at some way off thinking about that clear split. So we see real value when businesses get that right, and ticking the box for us if we're looking at it at the outset and it's there. It's not essential. But I think we often look at businesses, again, depends on sector, depends on data in the business, but around, where we typically start investing, that 3 to 5 of EBITDA are 50-50, and often a lot of them are at the point of sort of clearly separating them out.
Yeah. Okay, and just before I head into quick fire questions for you, what would you say separates a private equity CFO from the rest of the pack?
I think it's that that pace approach to it, that mindset of sort of growth, wanting to be a kind of business owner and thinking about it with that mindset. I think resilience as well is it's fast paced. There are challenges, not challenges from a negative perspective. Yes, there can be those that don't go according to plan, but even those that go really, really well, whether it's M&A, whether it's international growth, new strategies, new products, whatever it may be, all whilst in a leveraged environment, whilst your private equity house is constantly trying to focus on 3-4 years hence. There's a lot going on, and so I think that pace of change, the ability to cope with that, and resilience are sort of a couple of key traits for us.
Yeah, it makes total sense. Okay, so into quick fire. So 1 or 2 words answer. I'm not sure Peter managed that, but we'll see how you get on. Okay, so biggest red flag in due diligence?
Inconsistencies in the data, or just not being there or not stacking up.
Most underrated CFO capability?
Communication, openness, probably plays to the EQ point that Peter referenced.
Yeah, the metric that you look at first
in businesses, and probably margin and margin performance.
One thing CFOs overcomplicate in your view?
Modeling, but not probably. It probably needs to be that complicated, but when presenting back to the board, people use the point earlier, but often a lot of non-financial people around the table. So there's a great skill set in simplifying the 10 key assumptions that everyone needs to focus on, and explaining them at a level that everyone can understand.
Yeah, and then final one thing CFOs underplay.
I guess their ability to influence the whole of the business, and it's probably back to that sort of mindset shift. And once you get to a certain size, when you stop becoming that sort of managing the finance function to part of the exec team that's driving the business forward. So how can you partner? How can you help commercially deliver the outcomes and the objectives?
Yeah, brilliant. Thank you so much, Tom. It's been great to get you into the hot seat and really grill you on what a lot of CFOs are asking about during either pre-investment or in an invested environment. So really appreciate your openness and answers to all the questions. Thank you for joining us, and hope to see you at an Incremental Edge live event in the future. Thank you.